All right, welcome, AJ. Yeah, so basically today we'll be discussing about discount, premium, and equilibrium. What we want to talk about premium? When we talk about premium and discount, probably you've come across it before. What we are talking about is that it's more like the first law I gave you during the first phase of the strategy class that I said you buy low and then you sell high. Basically, if I want to turn it to the forex term, like economics term, what I mean is that you buy at discount and then you sell at premium. That's essentially what it means. When they say when I say like you buy low and then you sell high, it's a rule. But then you start to ask you start to question yourself that where is the high, where is the low? Like how do I know this is the low I buy from, and how do I know this is the high that I sell from? That is the reason why we actually have the premium discount, like the premium discount. I'm going to explain how to use this, but basically we use particular this particular information with Fibonacci. Actually, Fibonacci is not is not an indicator. It's just a tool that we use to actually identify the premium or the discount array. You get, we want to know when the market in a premium, or this market is actually in a discount, that is at a low. Is it safe to buy this or safe to sell? So basically, as a currency trader, you need to be familiar with the term premium and discount and equilibrium, which are important technical indicators in analyzing the currency charts. Understanding these terms can help you make a better decision when buying or selling currency pair. In today's discussion, we will dive deeper into what this term means and how they can be used in technical analysis. So basically, premium, let's start from premium. You know, when they say you sell high, that means you sell at premium, which means premium in the context of currency trading refers to the situation where the current market price of a currency pair is higher than its expected future value. What that means basically is that when the market is actually overbought, do you get? That means it is actually in a premium level. All right. When the market is, they call it overbought, which means like most of the people, they use indicator for that. But I'm not talking about the overbought of indicator whenever your RSI probably enters above 80 level. No, that's not what I'm talking about. I'm talking about real overbought when a market is, too high. That is, we should actually start anticipating a retracement, or we should actually anticipate a total reversal. That's when we know that, okay, this market is overbought. So we are talking about the premium level is when the market is overbought too. So like there are many buyers, and then we should actually see some level of retracement. Okay. And then the discount on the other hand is when a market is oversold. That is, we want a place where, there are a lot of sellers there. Okay, at this point, at discount level, there'll be a lot of buyers, and then at premium level, there'll be a lot of sellers. So when the market is oversold, we are actually looking at a place where there are a lot of buyers. Because when something is oversold, it means that thing means it is cheap. It is at discount. And when something is at premium, it means it is very, very expensive. It is at an high. All right. It is something that you don't want to buy at an high. You don't want to buy. It's too expensive. All you want to do at that point is that you want to become a seller. All right. And then what is equilibrium? Equilibrium is the midpoint. You are neither at what? At premium nor discount. You are just at the midpoint of price. Now, this is the thing. You know what they call negotiation whenever you want to negotiate a price, probably you want to buy something worth of like say you want to buy something worth of like say 2,000. Then no, let's say you want to buy like say a phone, and then the seller says the price of this phone is actually like 25,000. All right, and you'll be like 25,000 is too much. How about 10,000? Then the person say no, not 10,000, 20,000. Then it's okay, let me pay 15. The person says 17,500. Then you'll be like, okay, I'm going to pay 17,500. Then you pay. What you essentially just did is that you negotiated from premium down to what? To equilibrium, because you met at the midpoint. That is the midpoint of the price. Do you get? Which means if the price is at an high, you want to bring it to the midpoint, which is if you just see an impulsive movement and then you measure it with your fib. Once the price gets to 50% Fibonacci level, the price is at equilibrium. Then we can start, probably buying or selling. Do you get? That's basically what we are trying to discuss. Now, I'm going to zoom view this particular chart. This particular chart, can you see that normally if we are looking at price from the context of like, just price, we cannot never know if a market is probably at premium or at equilibrium. But basically, what we want to do to know what premium and equilibrium is that we want to measure, we are going to take, this is a price leg. This particular move is an impulse. Then you take a fib from below to above. The only thing you want to be seeing on your fib is what? You want to see just the 100% level, the 0 level, and then the 50% level. Anything above the 50% is the premium. Anything below is what? Is the discount. And then remember the rules. You buy at what? You buy at discount, and then you sell at what? You sell at premium. All right? So basically, premium, discount, and equilibrium can be used in technical analysis to help trader make informed decision about buying and selling currency pairs. What that means is that, number one, you can decide. Basically, what this tool does is that it gives you an area where you can be looking for buys, which means where you can be looking for to trade. Let's say you want to sell. You know that once you put in this tool, you don't want to be selling at what? You don't want to be selling at discount. No. You want to be selling when price retraces to like a premium level. And then you want to be buying when price retraces to when price is at a discount level. That's basically what this particular tool is for. So for instance, if a currency pair is trading at a premium, it might be an indication that it is overbought, like I told you in the last slide, and could be due for a correction. That is, you can use it to anticipate like, okay, I think it's time for me to trade this correction. Then conversely, that if a currency pair is trading at a discount, that means it might just be oversold. Then you should actually be expecting a rebound, like a buy trade. All right. So traders can use premium and discount and equilibrium to identify potential buying and selling opportunity, which means if the currency pair is trading at a discount is a good time to buy. That is, the market is currently cheap. And then as the market might be, because the market might be undervalued, that is very, very cheap. Similarly, if a currency pair is trading at a premium, what can you do? It might be a good time to sell, which means the market is being overvalued. All right. That's exactly what it means, basically. So I'm going to zoom this one in so that you guys can literally understand what I mean by premium and discount. All right. If you guys have any questions so far, you can just drop it on the chat, okay? So basically, if you can see this place, like this is just a textbook version of the chart. I'm still going to go to the chart and then explain exactly what I mean by that. All right. So basically, this is an impulse leg. Like this particular move is an impulsive leg. Then what happened? We took a measurement of Fibonacci from this high to this low. The only level present on the Fibonacci retracement tool is just the 0%, the 50%, and then the 100%. Now, once you are expecting a retracement, if the market is retracing, anything at the premium price level, you do not buy. No matter how tempted you are, you wait for price to come to 50% equilibrium level or below. That is, you should come to a discount level before you buy. Anything below, probably your 61.8 golden mean ratio or your 70.5 optimum trade entry or whatever. It's just discount. You can buy from there. But anything, if you see that the market has started retracing, and they probably retrace the D2, and then you want to be buying here, that's actually a buy choice. You want to be buying at what? At premium level. You want to be buying at a discount and be selling at what? At premium level. And then also for the second particular textbook representation, we have a swing to the downside. Then if you measure this swing using your Fibonacci retracement, what you want to be saying is that you don't want to be selling inside the discount level because the discount level is anything below what 50%, just like this. So if the market is in a downtrend and then you bring your Fibonacci to from 100% to the 0%, that is by measuring this particular first impulse, you don't want to be what? You don't want to be a seller right inside this discount level. You want to be a seller right here at the premium. So whenever I'm measuring that, okay, price is still at a discount, I cannot sell now. It means price has not even retraced to what? 50%. I can't be looking for sale at that particular time. Although, like I said, this is not a rule for the market. Market can do just anything it likes. But most often than not, when the market is retracing, it will retrace at least 50% of its move. All right? Or even more. That's just basically what it means. So you don't look for buys at the premium. You only look for what? You only look for sales at premium and vice versa, which means you don't look for sales at discount. You only look for what? Buys at discount. All right. So basically, this is what it means. So now let's check this chart for an example. This particular chart, this one. Sorry. This particular chart. Okay, it's not that clear, but I'm going to go to the next slide. But basically, this particular chart is trying to talk about the premium and discounts. But let's go to the next slide. It is going to make sense. So now, basically, what this means is that this is the last impulse leg that broke structure. This particular move is the move that broke structure. If we measure it from here to here. So now, for our premium and discount, what we want to do is that we want to measure this one, bring our fee from here to here. All right? Which means anything at premium that is above the 50% level, we are not interested. Basically, that's what we are saying. Which means price is retracing like this. Can you see that the retracement starts here? And then you see the first impulse and price is retracing. Trust me, you don't want to buy this market. Although market moves nicely, you'll be expecting the market to break this high and then probably go somewhere. But basically, I wouldn't buy here at what? At premium. Buying only starts from what? At equilibrium, or if you start your buys from equilibrium and then more buys at discount. Which means you want price to first come to the 50% level first. Yes. Before you what? Before you start buying. Which means if you have if you have, probably you use order block or whatever you use. I don't want to teach order block right now or anything. But if you use anything to trade, support and resistance, mention it, imbalance, FVGs, anything at premium. Can you see this is an FVG right here? Like an imbalance. Market reacted to it but broke it. Like, we don't look for anything above this place. We don't look for any confirmation. We start looking for confirmation here, like this breaker block. All right, right here, or this other block at discount. This particular guy, this block, can you see this block? This other block, this one, below the 50% or at the 50% level is what we are going to mark as first. We can, even though this is an order block, we can never mark it out. Even though this is an imbalance FVG, we can never mark it out because it's at what? It's too expensive. It is at premium. So what this particular tool gives you is that it streamlines where you look for, like, where you look for your zone, that is your demand and supply zone. All right. For now, if you want to buy, the demand zone you'll be looking for will be at 50% below or below. All right. So you don't look for anything above this place once you get an impulsive movement. That is exactly what this particular chart is trying to tell us. So this one, you combine it with what? I've taught you only two things, but I've not really gone deep on liquidity, but I've already showed you the market does some sketchy shit. But this particular timing, will either confluence with New York opening or around New York session that overlap, or London opening around this time. But I don't know the time right there, but I think this is 12 p.m. Since this is 12 p.m., we can actually have that this is about 1 or say 2, which is about New York overlap. That's combining this with time that market is approaching the equilibrium level. And then basically, if you want to use liquidity, this particular low, because a lot of people has been induced to buy here. A lot of people would have FOMO'd it. I don't want to miss this move. Another impulsive leg has started. So they start chasing price. They start buying right from here since they saw that market has been going up from here. So they start buying. But basically, they will set their stop loss below this low, which is the low that their so-called retracement started. But price took it out. Form an equal low before taking it out, which means there's liquidity, there is timing, and then price is at equilibrium. That's theory conference. I've only taught you 3 things. This particular buy trade is a 3/3 trade. Do you understand? Like, basically, you don't want to be looking for buys inside the premium area. You only want to buy at discount, and then you only want to be selling at premium. But when I say sell at premium, what do I mean? I don't mean that you sell this retracement. No. That's not what I'm talking about. You just anticipate retracement, and then once the market is in an uptrend, what you want to be doing is that you want to be waiting for all the retracement that it is doing to come to a discount before you buy. Don't even try to counter trade. You can learn that later. I'm going to teach more on counter trading later. But basically, what I want you to learn now is that don't try to counter trade using this method. Just measure your move, then wait for price to come to your zone, be at discount, and then that's where you buy, basically. So let's go to the next slide. This is the next slide. Just showing more examples of premium and discount. This is the breakout structure. This is the measurement. That is, this is the impulsive leg that broke the structure. So take your Fibonacci retracement, measure it, and then can you see market retraced what? Market retraced to the discount level before we can start looking for anything like buys or sells. All right. So which means we can never buy above the 50% level. That is, we can never buy around the premium at all. We only start looking for buys right here, looking for confirmations right here. And then for sales too, can you see that this market is in a downtrend? This is a BOS. If I take my fib and measure this impulsive move, this one to this place, you see that this retracement is at premium. 50% will be somewhere here, and then retrace to premium before the selling started. That's basically what I'm saying. So this is the example that I gave. This one. So selling starts from, we only start selling around what? Around premium. And then more selling around what? More selling when there is something called deep discount and deep premium. Deep premium is when price comes to like 70% level, 90% level. That is, that's retraced a lot. That's deep discount. That means that market is too cheap. And then there is deep premium. All right. That's when market is, overbought. That is, when I measured it, it didn't retrace at 60.1 or whatever. It went down before retracing, which basically means I can still be looking for sales right here. Until, of course, markets break structure and then tells me that we are now in a bullish condition. So that's basically what this tool is for, the premium discount tool. So this is an example of a trend. If you can see this market is actually in an uptrend, basically. This market is in an uptrend. So now let's look at all the higher highs and higher lows, where the higher lows are stopping and where the higher highs, you get what I'm trying to say? So this is an higher low, higher high. Then take your Fibonacci from an higher low to an higher high. We will never buy all these ones that it has been doing. We're never buying from there. We are never buying. We're waiting for price to come to discount before buying. So we'll be buying this move. Do you get this particular move? So market went up again and then retraced, then give another impulse. Measuring this move again from this impulsive leg to this one, because this impulse started from here. Although there's another impulse here, but this particular impulse started from here. All right, because this is the breakup structure. So this impulse started from here. So basically, market, and you see all this move that it is doing. Look at this, all these ones, we are not buying them. And this is even an equal low. And then price dipped into what? Price dipped into the discount. This is when we start looking for buy, when price came to the discount level. Then look at the next swing. Measuring this move, can you see that price retrace to the discount level? This is another impulse. Price retrace to discount. I'm just trying to make you see this in terms of a trend, that we only buy at what? The discount level. And then if it is a downtrend market, so we only sell at, we sell when the market is in a downtrend. We only sell at the premium level. All right, that's basically what I'm trying to talk about with premium and discount. So by tomorrow, oh no, we don't have any class tomorrow, but basically the next meeting for this, I will talk about the 4 possible states of the market. We are going to be talking about the market can only be in like 4 possible states. Nothing or that. Is either market is consolidating, expanding, retracing, or reversing. So I will tell you about each of these stages and then what to expect, how to trade them during the next class. Okay. So basically, your assignment for this particular lecture is to actually go back to your chart, okay, basically, and then look for areas of discount and premium based on your understanding. Like, okay, look at the trade you could have taken that, okay, probably you've taken a trade before that you didn't even have any idea. Probably you took this buy and the market took you out, came down, then you'll be like, why did the market have to come this low? Market is just trying to come to the discount level. So just mark out your area of premium and discount and tell me that, okay, you buy at what? I buy at what? At equilibrium, and then more buys inside the deep discount. Do you get? At equilibrium, at this discount, then you do for premium also. All right, basically, this is what I'm asking. Just look for 5 examples of each, where you see a break of structure and impulse, and the market retrace. When did the retracement start? Where did the retracement end? Like I told you, you will find an example of where the retracement retraced in the premium zone when the market is extremely bullish, probably during news. But basically, when the market is normal, like what you want to see is that this, when you measure it, did it come to discount level? Like, did the market come to the discount level, or it just went? I want you to make a research on this. And also, something like this too. Measure this move with your fib. The only level you want to be seeing on your fib is what? Is the 50%, which is equilibrium, and the 100%. Just measure it. Anything above the 50% is premium, and anything below is discount. All right? So basically, you want to see the extent to which have you ever asked yourself that this particular market has started retracing? Where is it most likely to end? Most of the time, you start looking for all this level that could reverse price, like support and resistance zones. But right now, I don't want you to think that way. I want you to start looking at it in terms of premium. Is the market even in a discount level for me to start looking for buys, or the market is in a premium level where I don't look for buys? I look for sales at premium, and then I look for buys at discount, and then a very sweet buy with small stop loss at deep discount. So basically, this is the assignment I want to do. Just find 5 example, any currency, choose any asset class you like, any currency pair. But keep in mind that you see this market sometimes can reverse as premium. I'm still going to, show you a lot about, like, I'm still going to tell you more about that. But basically, what I want you to understand tonight is that you see this particular retracement. How far can a retracement go? For a buying scenario, that is for an uptrend, a retracement can go as far to reach for discount. Which means if the market is not at discount, you don't look for buys yet. You wait till your market is at discount level, then you start looking for buys. Once it touches the equilibrium, you can start looking at a lower time frame for buys. Okay. Then also you can combine it with liquidity. Like I told you, this is an equal high that the market took out right here. Then you can combine it with timing, just for your own off tracker, on tracker. You get, just for you to learn more. When did the market start reversing? What time did the reversing start? Is it during the London session or during the New York session? Is it during the London Q zone or the New York Q zone? So check the timing when the reversal starts. Check the time it came to what? Discount, when it started actually buying. And then check if there was liquidity capture. All right. So that's basically the assignment that I want you guys to actually do for me. All right.